Today we're going to take another look at Nvidia. Ever since their recent run-up and their recent earnings, they beat estimates and now they are trading at almost 1150, which is pretty insane. Their market cap being 2.8 trillion, which is just below Apple and just below Microsoft. So third largest company in the world and very, very close to overtaking the other two, which is crazy because most people have never even heard of Nvidia and don't even know what they do. So currently, well, over the past 5 years, they're up 3,000%. Obviously, crazy performance. The price to earnings ratio is 66, quite steep at the moment. On a forward basis, it's much lower because they have had recently good earnings growth. And it's coming from data centers and AI. So here we go. Let's take a look at the statements here. Their revenue has gone from 9 billion up to 60 billion, and over the past few quarters, we could see that their growth has been pretty crazy, up to 26 billion, and moving forward, probably going to be 28 billion and maybe 30 billion in the quarter after that. At some point, this growth is going to slow down as people need less and less chips, or they build out their infrastructure and then they really have to see the revenue from that infrastructure before they end up buying any more. Anyways, their margins are very, very good. They have crazy gross margins and crazy net margins. Their net margin at like 55% or 60%, pretty nuts. Balance sheet, their balance sheet is very, very good. Negative 20 billion in net debt. Cash flow, they buy back some stock and they pay a very tiny dividend. But yeah, they mostly just buy back stock with their cash, and they're projected to buy back lots and lots of stock this year. Taking a look at their stats, we could get a better look at their margins. Their return on invested capital is nice and high. Their gross margin, 62 going up to 70%. Net margin was 36, 35%, but now it's at 48 and 57 in the last quarter. So very high net margins. Yeah, that's what we can get from this. I guess we could look at the forecast, see what the analysts are thinking, and the minimum is 655, but most people say strong buy, which is pretty crazy that 48 analysts say strong buy. Let's look at the presentation here. So something that I gathered from this is they said demand for H200 and Blackwell is well ahead of supply. Expect demand may exceed supply well into next year. So that means that the demand for their chips is quite high, and they could probably sustain their revenue for quite some time. That's what I'm gathering from that. And then we've got their outlook. They're expecting 28 billion next quarter. They'll probably beat this, maybe like get 29 billion or 28.5 billion. Maybe it's possible they get to 30 billion. And yeah, gross margin 75%. What the analysts think, the analysts are thinking next quarter 28.6 billion. So yeah, they're thinking they're going to beat. Anyway, 24 or $25 a share going up to 33. That's like a 45% increase. And then their revenue estimate going from 110 billion to 146 billion, which is a 32% increase into 2026. You could see the low range at 122 billion and the high range at 190 billion. So there's quite the spread between the high and low estimate. Yeah, not much of a consensus there. Let's take a look at the stats. Look at the short percentage, if I can find it. What the heck? Is this not loading in or what? Stats. Maybe it's just not loading in. I have it here too. Let me see. Short percentage. Pretty sure I could see short percentage here. Short interest. Total shares short 27. What percentage is that? Percentage of shares shorted 1.13%. So pretty low short percentage. That's a green flag. Now to the model. So they are trading at quite the premium, we'll say. Earnings per share, I put the estimates here. So we're using the analyst estimates, and based on what the company's guiding for, I think that this is reasonable. And buybacks of 25 billion, net debt of negative 20 billion, discount rate of 10% because I want a 10% return on all my stocks, and an exit multiple of 25. Currently, they're trading at 66. I think that their growth is going to slow, but they are a quality company. They have like no debt and they have a moat. So I think an exit multiple of 25 is good. You could maybe push this up a little bit, but I think 25 is okay. And in terms of growth, I have their earnings growth at 40%, and then slightly declining down to 5% growth. I think this is reasonable. When you get larger and larger as a company, and you have higher and higher earnings, it makes it harder to grow the earnings from that point. So that's why the earnings growth declines over time, but it's still growing. And in terms of their revenue margins model, I have their growth at 32%. That's what the analysts are projecting, and then slowing down to 20, and then 10, and then 5. I think this is a very reasonable projection for Nvidia, and the profit margin at 55%. That's what they're expecting this year, and expanding up to 58% for the foreseeable future. And if these assumptions come true, then the fair share price is going to be about $875 a share. And with them trading at 1150, they are currently overpriced. This isn't so bad. Like, if you bought them today, assuming that these assumptions play out, you're probably looking at like a 6%, 5% return. Probably like a 6% return you're looking at. However, there is a risk that this scenario doesn't play out. Like, especially if you think that competition is going to come into the space, or if you think that the industry is cyclical, which it is, by the way, then I could easily see that this 2026, they have negative revenue growth because people bought all the chips they needed. And let's say that happens, well, then their fair share price drops all the way down to 661. Now, let's say some other competition comes into the space, maybe in 2027. Like, at some point, competition is going to come into the space. We don't know how long it's going to be, but I think 4 years is going to be lots of time. And we could see maybe their profit margins decline from 58 down to maybe 50, and then maybe 45, and then maybe they get down to 40, and then maybe 30 at some point. Maybe their profit margin declines all the way down to 30. Like, I think that this scenario could easily happen. And in this case, then they're only worth $400 a share, or 402. So yeah, there's definitely some different scenarios that you got to watch out for with this stock. I definitely am not buying into it at this point. I think that I totally missed the boat on this one. And I think that it is kind of in a bubble right now with the amount of hype around AI. I think that the software companies really have to start seeing a profit in their AI side of their businesses, because right now we're not seeing that. And before they're going to ever buy more chips. So yeah, that's what I think. Let me know what you guys think in the comments. Let me know if I'm an idiot or what. But yeah, I just don't. I think that this is like a replay of Tesla. Like, Tesla was super hyped and now it's not. And you can see how much Tesla has fallen from its peak. So yeah, let me know what you guys think in the comments and hit that like button. I'll see you in the next one.